Hi, good morning, everyone. Thank you very much for joining us. It's a big privilege to be able to present to you this morning. And also thank you very much to Fani and the FC Wealth team. Thank you very much for having us this morning. I'm going to give you an economic overview, and I'm going to focus on the big long-term uncertainties that we're currently seeing in financial markets. And from there, I'm going to try and give you more insight into how at Allan Gray, we are positioning our portfolios, our clients' portfolios, in order to be robust and defensive against those uncertainties that we're seeing. Before I get into the detail of that, I do just want to give you a quick introduction or a refresher maybe on Allan Gray in case you're not familiar with us. So we are a privately owned investment management firm. Being privately owned, we think, is really important. It's been a critical part of our ability to look after our clients' wealth over the last 50 years. And I'll touch on that in a bit more detail later. As I mentioned, we have been doing this for 50 years. So we were established in 1973. And investment management is a competitive industry, right? So to be able to look after our clients' wealth and not only protect it, but to be able to grow it over 50 years is something, firstly, we take very seriously, but also that we pride ourselves in. It really is the true cause of our business. Other point I'd make is we have grown over the years. We are managing just over 600 billion rand of our clients' investments, and most of our offshore investments are done through Orbis. So Orbis is our sister company. It was also founded by the late Dr. Allan Gray. It shares the same values as us. It shares the same focus on doing the right thing for clients. It shares the same DNA as us, and it's got a very similar investment philosophy and process. So having an offshore investment partner that shares our values, that shares our approach to investments, we think is really important, and it gives us a lot of comfort that we have this long-term relationship with them. Right, so having gone through the introductions, what are we seeing today? I think the first point I'd make is that there's always uncertainty, right? If you look at the chart here, shows you the returns from investing in the South African Stock Exchange over the last 50 years, so since Allan Gray was founded. And what's remarkable about that is there's hardly been a time when there wasn't some kind of uncertainty, some kind of crisis. That's just part and parcel of investing. So the chart shows you if you invested 10,000 Rand in the South African Stock Exchange in 1974, you'd end up, that 10,000 Rand would have grown to over 20,000 Rand, 20 million Rand by the end of the period, right? So some of you might be skeptical and say, sure, but just a lot of that's inflation. But actually, if you adjust for that, you still made 48 times your money over those 40 years. That's after inflation, right? So despite this uncertainty, the South African Stock Exchange has actually been a fantastic place to invest over those 50 years, despite that. And you can see, sort of every couple of years, there have been these massive bouts of risk, of crisis, of uncertainty, whether that's, after the 1973 OPEC crisis, inflation going to double digits. You then had the sanctions, the state of emergency in the 80s, all the uncertainty leading up to the first democratic elections in 1994. You had the dot-com bubble and the emerging markets crisis in the late 90s, early 2000s. You had the global financial crisis in the late 2000s. You had the COVID pandemic. So despite all this, if you remained invested, and that's the key part here, you did well. And you were able to grow, not only protect your capital, but also grow it. But this is just the index, right? So what you also then could have done is you could have invested with the asset manager that's able to outperform the index over the long term. This chart shows you is Allan Gray's returns on the left-hand side during up months, so in the good times, so in times when markets are up, in the middle during down months, so in months where the market is down, and then on the right-hand side, combining those two data sets, so over the whole period from 2000, so over the long term. What you can see is during the good times, so in months when the market is up, and the dark gray column is Allan Gray Equity Fund, and the shaded gray column is the all-share index, so the market. During the good times, Allan Gray tends to underperform. right? Usually when markets run hard, we try and keep up with it, but typically we lag a little. However, during the bad times, so during times when the market is down, Allan Gray tends to fall by considerably less. We protect our clients' capital better, and that enables us through the cycle, so in the fullness of time, to outperform. Now, you might be skeptical and you say, okay, the difference between 1.3 or 1.2 per month doesn't sound like a lot. But actually, if you compound that over 50 years, which is the typical investment period for someone who works and then retires, that means you end up with 80% more money over that period. So it makes a massive difference to your final outcome if you're able to protect capital better during those down months. We've been doing this for 50 years, and there are a couple of key things that have enabled us to do that. And I'll touch on that in the next couple of slides. What I will say is the proof is in the pudding. So you can see on our since inception numbers, so this is the red is showing the equity fund compared to the benchmark, the balance fund compared to the average balance fund, then the stable fund compared to its benchmark. Over the long term, we've been able to outperform the markets and not only protect but also grow our clients' wealth. Over shorter periods, the performance has also been reasonably good. We have lagged a bit over the last year, but again, that's typical Allan Gray. It does what it says on the box. In a year when markets have run fairly hard, we would typically lag a bit, but then you more than make up for it during the bad times. So how do we do that? And from there, I'll flow into what we're seeing in the markets. I think the first point is there's a fantastic book by an investor called Richard Oldfield called Simple But Not Easy, and it's about investing. Investing is simple, but it isn't easy. So our investment philosophy, something we've implied consistently for the last 50 years. So you can go back into the 1970s and 80s, and in our client presentations, okay, the graphics were maybe a bit more clunky, but the basic slide is the same, right? Our investment philosophy has been consistent, and it's really quite simple. We say that the price of a business, the share price, the red line here, can go up or down on any given day, and we don't know what's going to happen with that. But what we can do is we can calculate the intrinsic value or the fundamental value of a business. And we then try and buy the shares of the business when the share price is below the intrinsic value, and then sell them when it's above the intrinsic value. Now, maybe an intuitive way to explain it is we all try and do this when you're buying a house or you're buying a car, right? So you look at the house and you work out what do you think it's worth. Does it have a pool? How many rooms does it have? And you then try and buy it at a bargain. You try and buy it at a price that's lower than it's intrinsically worth. We try and do the exact same thing with shares, right? And by buying it below the intrinsic value, you have a margin of safety. Because even if things turn out a bit worse than you expect, you're still buying something at a discount, at a bargain. And that's how you generate superior returns. The other part of it is we have a big emphasis on the things that we can control versus the things that we can't control. And that's really crucial. Why do I say that? So if you think about investing, you can have a very good investment process. So you do diligent research on the companies, you meet management, you talk to their competitors, you look at the whole industry, you make sure that you buy in at a decent price, at a low price. You're very, very aware of risk management, and you do that in an efficient manner. But you might have bad luck. So for example, you can look at the South African hotel groups in 2019, and you can say, actually, they're trading at record low valuations, and actually, maybe there's room for quite a bit of growth. You can see the business plans are starting to make sense. But then you buy in, and a couple of months later, the COVID pandemic hits, and suddenly hotels are shut for a year. Your process was good, right? You did the work, you made a rational investment decision, but you had bad luck, so your outcome is bad. Conversely, you can have a bad investment process. You can buy whatever share you hear someone talking about at a braai, or whatever is trending on Twitter. And then maybe you strike it lucky and the share price goes up a lot, it becomes a meme stock or whatever. Or maybe you're unlucky and then it ends up being a bad investment. The point is you have a bad process. Now, why is this so important? It's important because we don't control luck, right? That's something outside of our control, and it's something that fluctuates. But if you have a good investment process and you stay invested for the long term, luck balances out over time. And that enables you to reap the benefits of skill. And that enables you to compound that good process, those good investment decisions. Luck balances out over time, and that's how you get superior investment returns. And that's really important. So part of that then is what I can call the emotional roller coaster of investing. And if you look at what's been happening in the markets over the last couple of years, it really has been an emotional roller coaster. So maybe an example is leading up to the elections, people were extremely concerned. I mean, there was a very real possibility that the EFF and MK form a coalition with the ANC. Floyd Shivambu could be our finance minister. These were real prospects that people were talking about and were driving investment decisions. There was a time of fear, despondency, and despair. That's typically as contrarian investors, and contrarian just means doing the opposite of what most other people are doing. That's when we as contrarian investors see the maximum opportunity. Why? Because expectations are very low. You can buy in at a bargain, and that's typically when you get good investment returns. Conversely, during times of excitement, thrills, and euphoria, so when it feels like the Magnificent Seven can only go up, right? Just buy them and forget about them, and they can only go up. That's typically when, as contrarian investors, we become cautious. And we say, markets are too optimistic, there's too much good news being priced in. This is when the risks are at their highest. And again, just coming back to my first slide, being an independent asset manager, I think, is really key to allowing us to be contrarian, taking a long-term view and looking through the noise. So you might say, okay, Pieter, this all sounds great in theory, but in practice, what does it mean for investment decisions? So we spoke about the Magnificent Seven. This is Microsoft, which is obviously one of the Magnificent Seven, and a company we all use every day. Each one of us uses Outlook or Word or Excel or some kind of Microsoft product. So what this chart does, I'm just going to simplify it, is it shows you the black line is from 1998 to 2010, so a 12-year period, by how much Microsoft grew its cash profits. So essentially how much it grew its profitability. You can see it grew from, this is scaled to 100, so from 1998 to 2010, it grew from 100 to about 230. Okay, so just 2.3 times. The pink line then shows you the subsequent 12-year period. So from 2010 to 2022, how much Microsoft grew its cash profits. And remarkably, over the subsequent 12-year period, it also grew it from about 100 to 230. So over those two 12-year periods, Microsoft's growth in cash profits was the same. But growth in profits is not the same as the return you get as a shareholder, right? And that's an important distinction. So what happened to Microsoft shareholders over that period? So the black line is Microsoft from 1998 to 2010, the return you got as a shareholder. And for 12 years, in nominal terms, it went absolutely nowhere. You could have been stuck in Microsoft for 12 years without making any money whatsoever. But then, in the subsequent 12-year period, if you bought Microsoft in 2010, the red line shows you made 11 times your money back. It was a phenomenal investment. Now you sit and you go, but wait, the growth in its profits was the same over those two 12-year periods. But in the first one, I got 0 return on my investment. And the second one, I made 11 times my money back. It was one of the best investments in the world. What's the difference? Why? What's causing this? So the main cause of this is valuation. And that's why, as a valuation-driven investor, we place so much emphasis on what's your starting value. So if you bought Microsoft in 1998, you were paying just about 40 times its free cash flow, its cash profits. So for each year's cash profits, you're paying 40 times that. It's a very high valuation. Conversely, if you bought in 2010, and this is difficult to fathom now just given how successful Microsoft has been, you could have bought Microsoft for less than 10 times free cash flow. That's cheaper than most shares on the JSE today. Right? That's astounding. But sentiment was horrible then. Expectations were extremely low. And that's typically what sets you up for good investment returns. Conversely, in 1998, going into the dot-com bubble, expectations were extremely high. So even though the profit growth was the same, it's really, really important what valuation you buy in. And just by the way, Microsoft is back to trading at just about 40 times free cash flow today. So there's maybe a bit of a over-optimism there. So having explained how we think about investments, what are the key uncertainties and the key risks we're seeing on the investment landscape today? I'm going to start globally and then bring it back to South Africa. So the first point I'd make is, after the end of the Cold War in the late 80s, we had a peace dividend. So what happened? Globally, there was less armed conflict, so governments could spend less on munitions, on defense, and more on growing their economies, which was fantastic. There was also more globalization, so supply chains integrated, and you could move production, which maybe cost you $100, to a country with cheaper production, which cost you $80, which is also great for economic growth. That's gone into reverse now. So we've got a hot war in Eastern Europe, Russia, Ukraine. We've got a hot war in the Middle East, and that looks like it's spilling over. So initially Israel, Palestine, Gaza, now going into Lebanon. Iran is increasingly involved too. So this long-term structural benefit is going into reverse. And what we're seeing now is there's incredible uncertainty, not just about energy prices, which is impacted by both of those, but also rising tension between China and the West, especially the US. I mean, China has said it's an explicit aim of theirs to reincorporate Taiwan within the next 10 years. Now, Taiwan manufactures most of the world's semiconductors, which we need in every single phone and computer we use. If China does that, it will cause massive, massive ructions. And it's very, very difficult to predict when that happens and also what the impacts would be if that happens. On the same page, governments are also now rearming themselves, right? So instead of spending money on education and hospitals and economic growth, they're spending money on weapons because they want to protect themselves in light of this uncertainty. So that's the first key point. And what's making this even more difficult is elections. So you might know, just about 48% of the world's population is voting this year, the highest proportion ever. Now, some of these elections are very easy to call and don't really make a big difference. So in the UK, everyone knew Labour was going to win. That was quite clear. And it doesn't really have an impact on global markets, not materially. But some of them are incredibly difficult to call and could have a very big impact. So in the US, 5-6 months ago, Trump was far ahead, and then suddenly Biden withdraws, and now it's essentially a coin toss. It's too close to call currently. And depending on who wins, it could have a very material impact. So in some ways, it doesn't matter. Why do I say that? Whether Trump wins or Kamala Harris wins, neither of them is fiscally irresponsible. Both of them are going to grow government expenditure, and the US government is going to keep spending more money than it gets in revenue, right? So in that sense, it's sort of a bit of a moot point who wins. But on foreign policy, it can make a big difference. Their stances on China, their stances on Israel, their stances on Ukraine is very, very different, and that plays into global markets, right? So this increases the uncertainty. The second big source of uncertainty that we're seeing is inflation and interest rates. Now, as South Africans, we're quite familiar with inflation. This isn't something new for us. It's something we see every day. Our businesses are geared towards it. It's something we're used to. But if you were born in the US in 2000, you never saw inflation more than 1.5% up until the COVID pandemic, and suddenly it went to 12%. Right? So it's a massive, massive shift there. So inflation has come down since it peaked, but we're concerned because markets are essentially pricing in inflation in the rich world falling to 1 or 2% and staying there into perpetuity. And we think there are big structural drivers that will cause inflation and accordingly interest rates to stay higher for longer. So a couple of them are quite obvious, and we've already touched on them. So things like defense spending, instead of spending on economic growth, tends to be inflationary. Things like declining workforces and wage pressure. I mean, you've got the Boeing's staff in the US are demanding 50, 60% wage increases, right? That's unheard of in the US. So we're entering a new era there, and obviously 60% wage increases are inflationary. But then I want to unpack two of them in a bit more detail. I guess we spoke about deglobalization. So what's happening there is, instead of producing a washing machine in China, where it costs you $50, now everyone's bringing their production back into their home country. So now the washing machine goes from costing $50 to costing $100. That's also inflationary. I want to touch a bit more detail on decarbonization and debt. This slide shows you the US government's debt levels relative to its GDP. So you can think about it as the debt relative to the income for a household. And this is their own projection, by the way, so I'm not playing devil's advocate. And also, this is a very conservative projection because it excludes all the expenditure spending on, or liabilities on Medicare and Medicaid, so health and social welfare. Now, that's forecast to effectively double over the next 30 years. Now, if you're a household and you sit and you go, I can see my debt is going to double over the next 30 years and I have no credible plan for reining it in, that is extremely concerning, right? And that's exactly the situation the US is facing. Now, it is a bit different for the US because they have what's called the exorbitant privilege of having the world's reserve currency. So unlike every other country, they can print money without necessarily stoking inflation. But you can only do that up to a point before it gets into the system. Hemingway in the book The Sun Also Rises wrote about someone going bankrupt slowly and then quickly, right? So this could take a very long time to play out. But the point is, it's on an unsustainable track, and that's inherently inflationary, right? So we're really concerned about that. The other point is on energy. So what we see here is the columns show you energy consumption per person for the US, North America, Europe, South America, Africa, India, China. And you can see, as you can imagine, it's very high in developed markets. People use more energy, and it's very low in emerging markets, Africa, India, China. Then the red dots show you the populations for those areas. Much fewer people in the developed world, much more people in emerging markets. And there's an issue here, right? Because the world has a trilemma. So all the population growth is in emerging markets, and their energy consumption is also growing. Everyone in emerging markets aspires to Western standards of lifestyle, of energy consumption. So that's growing. But there's an issue with affordability, right? So part of the issue there is you need to expand the grid, you need to expand power generation in order to get that energy. There's also an issue with security. So as we saw with the Russia-Ukraine war, suddenly Europe had this massive energy crisis, which spilled over into energy prices in South Africa, in the US. And energy security is very much front of mind for most countries, and spending in order to get secure energy is inflationary. The other part of it is sustainability. So we're moving to a world that is decarbonizing, right? So we're moving to greener sources of energy. But the problem is the sun doesn't always shine, right? The wind doesn't always blow. So you need to spend more on green energy to get the same level of effective energy as for traditional fuel sources. The other thing is you also have to rewire the whole grid to be able to transmit that energy. That's also inflationary. So we're sitting there and we're saying the world is struggling to balance these three things. It needs energy that is secure, that is affordable, and is sustainable. And that's a real concern. And it's going to remain one over the next 20 or 30 years as the world transitions away from fossil fuels. You might say, okay, all of this sounds quite scary, but inflation's actually been coming down. And absolutely it has. But what I will say here is that doesn't mean that we've solved the inflation issue. And I think a good point here is to look at the lessons we can learn from the past. First one here shows you inflation in the US from 1966 to 1984, so the last period when there was double-digit inflation in the US. You can see OPEC crisis, 73, 74, inflation shot up to 14%. The Fed raised rates, brought inflation under control, it thought, and then it cut rates too early. Spoiler alert, and then it shot up again to 14%, and then Paul Volcker took short-term rates in the US close to 20%, right? 20% short-term rates before it came back down, but actually settled at a higher level than it was previously. So the red line, also US inflation, just from 2014 to today. Now, you don't have to be a statistician to see it seems to be following a fairly similar pattern. Okay, what I will say here is I don't have a crystal ball. I don't know what inflation is going to be next month or 2 months from now or 6 months from now. It's too difficult to call. But what I can say is I think there are real risks here. So what's the risk? The risk is that the Fed cuts rates too early and it shoots back up again. And they started off with a 50 basis point big cut, so there's a real concern there. But the other point is that even if inflation doesn't kick up that much, markets are pricing in inflation dropping down to just under 2% within 12 months and then just staying there for the next 2 decades. That seems wildly optimistic to me, especially in light of those structural drivers of inflation that we've been speaking about. So I think there's a real source of uncertainty and risk here. Okay, so having looked at the global risks, what are stock markets saying? Stock markets are essentially saying there isn't much to see here, move along, things are actually looking pretty okay. So this shows you the price to earnings ratio, so the valuation multiple of the world stock market. You can see it's a little bit high. It's sort of 21 times earnings. This is a 50-year chart, by the way, so quite long-term. The long-term average is about 17, 18. So it's a little bit high versus its history, which is surprising given sort of the high level of uncertainty we've spoken about. But it's worth drilling into the data in a bit more detail. So the light blue line here is the US market, and then the dark blue line is the rest of the world. The US is looking very expensive compared to its history. In fact, it's rarely traded on a higher valuation multiple than it does today. And that's a real cause for concern. And then actually the rest of the world is trading on a significantly lower multiple than it historically has. So that's typically where, as valuation-driven investors, we are seeing more attractive investment opportunities. It's not to say that there aren't opportunities in the US. I'm just saying in aggregate, that's typically where we're seeing more opportunity and where we're allocating more capital. Now, a lot of you might say, yes, okay, the US is looking expensive, but it's been a fantastic place to invest. And why would you go messing around in emerging markets or other places if you can just buy the Magnificent Seven? And there is an argument to be made for that, right? These are fantastic companies. The economics are great. But I think part of the risk here is that people take the most recent past and then they project it into the future. They assume that the future looks like the past, and that isn't a good way to do investments. Why do I say that? Let's look at the last 14 years. You can see the all-share hasn't been fantastic. This is in dollar terms. So you've got a little bit of growth, but not much. But actually, most of the rest of the world, so the pink line is the world index excluding the US. It's also not been fantastic over the last 14 years. The only place really that's outperformed over this period has been the US, so the S&P 500, the red line. And it's actually been very concentrated, even within the US, in the big tech shares, so the NASDAQ. So that's essentially been the only game in town for the last decade. You might say, okay, but this is very obvious. Why don't you just buy those shares? Problem is, people forget about what happened in the decade before that. So this shows you from 2000 to 2010, where over that period, the JSE, the all-share index, was actually the best place to invest. It massively outperformed the black line, outperformed the rest. The rest of the world, the pink line, did better than the US, by the way. And actually, the worst place to have invested over that decade was the US, right? So part of the risk here is saying just because the big US tech shares have done well over the next decade doesn't necessarily mean they'll do well over the next decade. And that's something that we have to be very wary of. Now, turning to South Africa, I mean, I think we all read the news. We're all well aware of what's happening in South African politics and the economy. So I'm not going to go into the details of that. But at a high level, there are a couple of points I want to make. So the first one is, this chart shows you the price to earnings ratio, so the valuation multiple of the JSE Midcap Index. So I use the Midcap Index here, and this is over the last 10 years, because the Midcap Index strips out all the big dual listers and the big multinationals, and it's mostly filled with shares that generate most of their profits in South Africa. So you can call it the SA Inc. shares. This chart shows you is effectively a gauge of sentiment on SA Inc. shares. And that's looking pretty low. So you can see compared to its history, the average is sort of 15, 16 times, and it's trading around about 10 times now. So you have had a bit of a boost from the GNU. It has kicked up a bit the last month or two, but I'd say it's gone from being extremely bad sentiment to being cautious, right? We're not in a period of optimism currently. Now, you might say, okay, this looks cheap. Maybe that's a very attractive entry point. And for sure, it does look cheap. But what I will say is it's not without its risks. So this chart shows you the same SA Inc. shares, the midcap index. It shows you the earnings of those companies in aggregate, adjusted for inflation. What you can see is over the last decade, South African companies have really struggled to grow their profits ahead of inflation. It's just been a very, very, very difficult place to do business in. And that obviously means there's higher risk. There are challenges. So it's looking cheap optically, but there's also a stagnant economy and higher risks. And that makes it tricky to navigate. And the risk, of course, here is that we have another lost decade where we sit here in 2034, and for another decade, South Africa has struggled to grow. Right, so that's something we're really concerned of. The last point I want to make here is on the government bond side of things. So I know when people start getting into yields, it gets all very technical, and it doesn't have to be. The way I think about this is it shows you the yield on South African government 10-year bonds. So the way to explain it is this is how much it costs the South African government to borrow money for 10 years. And that's the same as you or me going to a bank, asking for a home loan, and the bank tells you, actually, you're a good credit, we're going to give you prime minus 1.5, or actually, you're not a great credit, we're going to charge you prime plus 2.5, right? It's the same for the government. The government has to borrow money from markets in order to fund itself. So what's been happening to government bond yields? What's been happening to the interest rate that the market charges our government? You can see from 2001 to 2013, it fell a lot. We had a commodity super cycle, our economy was growing. People viewed our government as less risky, and I think our government debt levels were also considerably lower. Since then, it's moved up. It's been a steady trend upwards. It's now sort of peaked at just around 12% before the GNU was formed, and we've subsequently had a rally, so it's fallen to just under 10% as of yesterday. Now, part of the issue here is if you're borrowing at 7% versus if you're borrowing at 12%, it makes a massive difference to your economy. Because if you're borrowing at 12%, servicing the interest crowds out a lot of other expenditure, but also there aren't a lot of investments that give you a return better than 12%. But at 7%, it's a lot easier. So what we've had now is we've had a lucky break. You have some breathing room because the bond yields have come down. The government can now borrow at a cheaper rate. But the problem here is it's purely driven by sentiment. We haven't had meaningful economic and political reform yet. We haven't had the structural reform we need to grow our economy. So this isn't falling because our economy is growing faster or our government debt levels is lower. It's just sentiment, and we know that's fleeting. The second risk here is that the GNU, and that's definitely a step in the right direction. The problem is it hasn't been tested, right? It can fall apart overnight. And until we've seen the GNU go through a couple of crises and prove itself capable of handling it, it's very difficult to say that we are on a more sustainable fiscal path. And the proof would come through in the pudding, right? Of lower government debt levels, less waste, less fruitless expenditure, less corruption. But that hasn't happened yet, and that will take time. And because of that, we remain quite cautious, despite South African shares having done quite well recently. Okay, so where does that leave you as an investor? And I know there's been a lot of concern and uncertainty I've spoken about. I'm going to start with a couple of points of good news. So the first point is, if you were an investor in 1994, in a retirement fund, you weren't allowed to take any money offshore. It had to be 100% in South Africa. Currently, you can take up to 45% offshore in a regular vanilla balanced fund, like the Allan Gray Balanced Fund, or even there are lots of other good balanced funds out there, right? So up to 45% of your money in a retirement fund you can invest offshore. I'm not saying you should invest all of it offshore, but we do know that diversification is the only free lunch in finance, right? That's the insight that Harry Markowitz won the Nobel Prize for. Diversifying is inherently a good thing in investing. So the point here is that you have flexibility. So if you can look at 2004, and this shows you the portion of the Allan Gray Balanced Fund that was invested offshore, just because you can take 45% offshore doesn't mean you should. And the point is here you have flexibility to allocate capital to where you see the best opportunities. In 2004, the Allan Gray Balanced Fund had 0% offshore. Now, I imagine if I were to tell you today that there's absolutely zero foreign exposure in your retirement funds, you'd be quite upset, and we might get a lot of angry phone calls and emails from our clients. But the point is you've got the flexibility, and actually, by the way, in 2004, it was 100% the right call not to have money offshore because global markets were extremely overvalued. And over the next 4 years, South Africa materially outperformed the rest of the world. So that was actually the right decision. Today, the risks and opportunities are more balanced. So in the Allan Gray Balanced Fund, you're sitting at sort of just under 40% offshore. But that moves as we see risks and opportunities. And the point here is, as a client, you benefit from that flexibility. The other point is, of the 55% in a retirement fund that has to remain in South Africa, you've also actually got a lot of flexibility there. Why do I say that? You can divide the South African market, the JSE, into 5 buckets. So you can start with the green bucket. So this is made up of large shares that generate most of their profits in South Africa. So the likes of Shoprite, the likes of Capitec, the likes of Nedbank, they don't have a lot of profits from outside of South Africa. So their profitability tends to be quite tied to what's happening in our economy. You then get the resources shares, so the likes of Glencore, Anglo Gold, Ashanti doesn't have a single mine in South Africa, for example, but also they sell commodities that are priced in dollars. So all of their profits essentially come from outside of South Africa. They're not really tied to the South African economy, their profits. You then get the big multinationals, so the likes of Richemont, British American Tobacco, AB InBev. They generate more than 90% of their profits from outside of South Africa. So again, they aren't as tied to what's happening in the South African economy. You then in red get Naspers Process. So Naspers and Process's biggest asset is Tencent, a Chinese internet company, and then most of the rest of the value is actually sitting in global e-commerce businesses. Again, more than 95% of the profits are from outside of South Africa. The last block is the dark gray. So if you look at it on a look-through basis, if you just buy the index, if you just buy the whole South African market, 60% of your profits are also offshore, are tied to what's happening outside of South Africa rather than the South African economy. Right? So again, you're getting really good diversification. But what I will also say is that you can flex this. So if, for example, we're seeing a lot more opportunity in the SA Inc. shares, instead of buying the market, you can shift more capital towards that. Or conversely, if we think the risks are higher there, we can shift away from those into more rand hedges and companies that generate their earnings outside of South Africa. So again, as an investor, as a client, we think this flexibility is very, very beneficial. So how are we positioning our portfolios? And I think you can divide it into a couple of different slices. Of the exposure to South African shares, I think there are two sort of main ways of two main routes of exposure that we have. The first one is what we call SA Inc. self-help shares. So these are shares that generate most of their profits in South Africa, and most of these you'd know from your day-to-day lives. Remgro, for example, their biggest asset is Mediclinic, the hospital group. They also own stakes in the likes of FirstRand and a couple of other South African companies that you'd know. Why we like these shares is the following. So our argument is we don't know whether economic growth is going to remain weak in South Africa. We think there's a real chance that it does. But there's also a chance that we actually start performing and we get to the 3-4% economic growth we need. What we like about these shares is they have self-help. So they have different levers they can pull to generate growth, even if our economy remains weak. So the likes of Woolworths, for example, they've sold David Jones in Australia for a good price and returned most of that cash to shareholders. Their food business is phenomenal, but their clothing business in South Africa has been struggling, and they're busy turning that around. They're also busy fixing Country Road, which is their other Australian business. So here you can see, if our economy remains weak, we think they can fix clothing, they can fix Australia, and that's a way of generating earnings. But on the other hand, if our economy starts growing quickly, their food business is going to shoot the lights out. And it's also going to help their clothing business. So there's an asymmetry here, which we think is attractive. If the economy remains weak, you can still eke out some growth. But if things improve, if things turn out better than we fear, you share in some of that upside. And we think that's the right way to position a part of the portfolio. And the same is true of the investment cases for the other shares on the slide here. The second exposure in South Africa that we have on the share side is what we call foreign businesses, so businesses that generate most of their profits outside of South Africa that just happen to be listed here, but that are defensive. So we're not going for all the sexy go-go shares that are on 50 times earnings and depend on very high growth to do well. We're more defensively positioned. So the likes of British American Tobacco, AB InBev, the world's biggest brewer, here we have goods with companies with very strong brands. There's inelastic demand for their goods. They're trading on pretty low multiples and high free cash flow yields. And we think they're shares that do well in times of uncertainty, in times of high inflation, when there is a crisis, if there is war spilling out. Mondi is also in this bucket. So Mondi, we know if you buy something from Amazon, it most likely comes in a box manufactured by Mondi. So it's benefiting from e-commerce growth. But on the other hand, Mondi generates 75% of the energy that it uses, it generates internally by turning forestry into pulp, into paper. And most of its competitors has to buy in energy. So that's the same as being the only business with a generator when the rest of your competitors don't have a generator, right? So typically when energy prices go up, which we think there's a real chance of happening, Mondi's profitability tends to increase. So again, we think this is quite a defensive way of positioning it. If you then start looking at the direct offshore portion, so most of the offshore investments are done by our sister company Orbis that I mentioned. What they've been doing on the offshore side is they've been investing in companies that play to these different risks and uncertainties that we've been discussing, but they're typically outside of the US. And the reason for that is you can buy companies that essentially do the same thing, but that are trading on half or a quarter of the starting valuation as the US companies. So for example, you might say, we're very positive about AI. We think there's real growth there and there's a real potential to actually keep growing and for that to make a difference in people's lives. But why would you then buy NVIDIA on 50, 60 times earnings if you can buy the likes of Taiwan Semiconductor and Samsung Electronics, which also manufactures semiconductors, which is also part of that ecosystem and will also benefit from that, but is trading on less than a quarter of the multiple of NVIDIA. Right? So a similar theme, but at a lower starting valuation. And remember, we are valuation-driven investors, and our sister company Orbis is too. Similarly, on the energy transition, you can go and buy companies in the US that manufacture solar panels if you think that's where the growth is going. But typically, they trade on very high valuation multiples. You can buy Siemens Energy in Europe and Prysmian Group and Drax, which is in the UK, which plays a similar theme. It's also on the infrastructure surrounding the transition towards a less carbon-intensive economy, but it's on much lower valuations. And we think that gives you a large margin of safety. Orbis then also has quite a big allocation to gold shares, which we know tends to hold up better, and it's an uncorrelated asset. It does well when there is risk, when there is uncertainty. When you pull all of it together, and I'm talking here about the Allan Gray Balanced Fund, but I think a lot of the principles filter through into our stable fund, into our equity fund, and to the other funds in our fund range. When you look at it on a holistic basis, what you can see is it's very well diversified at an asset class level. So you've got about a third is invested offshore, just higher than that. You've got about between 5 and 10% in precious metals and hedged equities, which, as we've discussed, tends to be defensive. You've then got about 20-25% in those defensive SA shares that happen to be listed here but generate most of their profits from outside of South Africa. You've then got about 20% in SA shares that are domestic businesses, but mostly those self-help shares that we spoke about. And then you've got the remainder in South African government, mostly government bonds and cash. So if you pull all of this together, it gives you a portfolio where we can say, we don't know what's going to happen. I do not have a crystal ball, but we are seeing a lot of uncertainty, more uncertainty than usual. And that means the range of potential outcomes is wider than it usually is. We think at an asset class level, the way that this portfolio is constructed is defensive against this wide range of outcomes. But more than that, within each asset class, we've also been going for shares that we think will hold up well regardless of the different risks that may or may not materialize. So that's really important in terms of how we construct the portfolios from the bottom up. So at an asset class level, we think it's very well diversified and defensive, but then also within each of the asset classes, we've also been very deliberate in the specific securities that we're selecting and putting into your portfolios. So I know it's been a lot. Let's just simplify it and pull it back. So what are the key messages I want to leave you with? First one is, the world is more uncertain than usual. We are in a time of higher uncertainty than we've probably had for at least 3 or 4 decades. And that necessarily impacts how we position the portfolios. We don't know what's going to happen. We don't know who's going to win the US election. We don't know whether China is going to invade Taiwan. But we realize all of these things are possible. There are uncertainties, there are risks. So what we do is we think through all of these scenarios. We think if they were to materialize, how they would impact asset classes, how they would impact individual shares, individual securities. And we factor that into the valuations. And we think how the portfolio would behave if any of those risks were to materialize. We then build portfolios that are defensive against these various uncertainties, against these various risks. And the key thing here, our key focus is on protecting clients' capital. Why is that the key focus for us? The reason for that is if you protect capital, that means you can ride it out. You can stay invested. And that means over time, as luck ebbs and flows, it balances out over the long term. And by staying invested, by protecting capital, that enables you to focus on the good process, to compound those good investment decisions, the good process, and reap the benefits of skill over the long term. And that's how you get superior investment performance. Lastly, then, how are the portfolios currently positioned? So typically it's defensive. So we're seeing more capital going towards cash, for example, more towards offshore equities currently, and then also in a number of SA self-help shares that we think can do well and will benefit and share in some of the upside if the economy starts growing, but can still eke out growth even if growth remains weak. Thank you very much for your time.
So I think a lot of us are involved in businesses as well, but
Sure.
if that is the easiest part, let's say, to get businesses more effective and to get the known pushed out, you guys as investors or other people investing in companies, shouldn't there be more pressure on the companies to bring in change mechanisms, not only in municipalities and so on, but all over? Because there's almost like sitting on a gold mine, because there is a possibility to improve those rather than start businesses. I'm just wanting to know from an investor side, can there not be more pressure on businesses for coaches and business people to transform and sort of be involved in this? Because I think that's...
No, I think that's a fantastic point. I completely agree with it. I think what the market has effectively been doing is it has been also rewarding businesses, especially on the listed side, that are addressing some of those problems. So if I think about a share like Advitech, for example, part of that is saying there are massive issues in our educational system. If you have a private sector player who can solve some of those problems, it's been a phenomenal share to own over the last 20 years, right? Similarly, the market is increasingly differentiating between businesses that are able to or contribute to solving these problems versus ones that don't. So for example, if you start looking at the miners, the ones that tend to be more progressive in terms of having energy security, not being as reliant on Eskom, further along on the renewables journey, for example, which partially takes them off the grid, the market does reward that, right? So it is indirect. And I guess the other point I'd make there is, it's not our place as investors to dictate to a company, you should do this, you should do that, right? That's not our place. The best we can do is we can engage at a board level and say, are you thinking about these risks? Are you actually being proactive in not only mitigating them, but potentially capitalizing on them? And if a company doesn't do that, then I guess you've got two options, right? You can go full activist, which is messy and there's a risk it destroys value, or you can be constructive, try and build a relationship there and enforce incremental change, or you sell the share. Now, it's never great to just sell out, but my priority, like my whole reason for what we do, is to protect our clients' capital, right? That's the first and foremost goal. So for sure, there are shares that we have in the portfolio that are part of this transformation, part of solving the issues, but it is balanced. It depends on valuation. So there isn't sort of a hard and a fast answer. I wish there was, absolutely, but the world's just a bit more messy and there are a bit more trade-offs than that. Thank you.
What's your best advice on investing to beat inflation over time?
Okay, so I think the proof is in the pudding, again. So I think in times of uncertainty, cash is often attractive. People feel safe in cash. And currently in South Africa, cash rates are pretty high. I mean, you're getting, let's call it 8.5% on cash, where inflation is sitting at quite a bit lower than that. So you're getting sort of 2-3% real. But that's a very temporary phenomenon. So we know over the long term, if you start looking at 10, 20, 30, 40, 50, 60-year periods, the only way that you can reliably beat inflation is by having growth assets. So what's that? That's equities. So you have to do that in order to beat inflation over the long term. However, part of the problem is the volatility. Cash isn't volatile. That's part of what makes it so attractive as a safe haven. Equities are volatile, and a part of the issue is if you're in the wrong equities or you have too much equity exposure, when there's a shock, when there's uncertainty and you need cash, you might be forced to sell out. You can't ride it out to get that superior performance over the long term. So that's again why at Allan Gray we have such an emphasis on firstly protecting capital, because that means even though we are in equities and our balance fund has considerable equity exposure, by not having as big drawdowns when things do go pear-shaped, when there is a crisis, when there is uncertainty, you can better protect the capital and you can help your clients, you can help your investors to stay invested. And most of that growth exposure then enables you to outperform inflation over the long term. So I don't think you have to do anything fancy. I mean, if you want to go into hedge funds and all that, you can. But a simple balanced fund with a good asset manager will outperform inflation over the long term. Like there's a lot of data and evidence proving that.